have 16, 17 students now.
Okay, so I will.
You can start now or wait for 2 or 3 minutes. It's up to you.
Yeah. Okay, so I will wait. Yeah, maybe 2-3 minutes.
Yeah.
In order to have a maximum audience.
Okay.
Okay. And okay, looks good. I was trying to increase the volume. Is that okay? Or that's also? Okay. I can see that now we are 23. So we'll wait and maybe an additional 2 minutes in order to get you a chance. And Lynn, is the volume okay, or should I speak louder?
No, I think it's okay. If they don't want to be louder, they will adjust from the side, from their side.
Okay.
For me, it's perfect.
Okay, then maybe if it's not loud enough, just feel free to flag, to signal, and you can raise your hand, I guess, in this sort of presentation. And Lynn, is the presentation visible enough, or should I enlarge?
I think for me it's okay, but you can make it the full screen. It's okay. Now it's not full screen now. You can use F5 or F4. I don't remember.
Is that okay? Because I put on my screen on a large screen, but on full screen, but maybe it's not the same on yours.
Yes, it's still the same for me. Nothing changed.
Okay, so maybe it's everybody will be okay. 27.
Yeah, you can start now. We have a 27, and it is 7. It's a 3 minutes past.
Yeah, it's 3 minutes past, and okay. So we will. Thank you, Lynn. I will start, and if there are anything you want to change, improve, modify in the presentation, feel free to flag to ask the question or to flag. I will thank you to join this MEBF 18 session on the bank's management, and the purpose of this lecture is to make you capable or able to judge, to make an opinion on the bank performance, and to understand what the management say on the strategy of the bank and the performance which is associated to the strategy. And the big thing here is that bank is very specific. We will discuss that in further during the class. But the specificity is at first on the regulation. Banks are, say, old company, but at the same time they are regulated. So it's not okay. It's part of the old economy. It appears centuries ago, but the picture of the bank we have, as we have it now, was a little bit under big changes on the past, say, 30, 40 years. And this is something which is important because it's creating some additional constraint. On a normal company, on a normal corporate, a cement company or motor company, you will have a financial structure choice. You will have a lot of say leeway, a lot of degree of freedom in the management of the company until you do not bankrupt the company and you drive well the company. But for banks, you have external constraint, and we will work today first on the liquidity constraint, which is quite important, and tomorrow we will move on, or maybe later today, we will move on the capital constraint. So since it appears to be a little bit a dry topic, we limit the session to certain aspects, and we will provide you capacity to go further and to dig more if you want to dig or to view other aspects. The first thing I will mention also on the organization is that on the first part, we will close each session with a very quick quiz session of quiz. You are numerous, but the quiz are very simple. It's yes and no, so I believe we can manage it very simply. The other thing is that we will make a break in order to allow the part of you who do not have the possibility to have a dinner to have a short dinner. So we will make a break of 15 minutes, maybe more or less at 3:20, 3:30. Sorry, on your time, 8:20, 8:30, and we will try to be to have some exercise too during the session. This is a roadmap. So I will provide you in the session some additional lecture as mentioned, and on those lecture you will have the capacity to go on different topics. So now I will try to move to the other file. I don't know why. Lynn, you don't know, I'm sorry. You don't know why I cannot move? It seems that I cannot move my screen onto the... So maybe because I'm at full screen? No. I apologize. We test a couple of the session, the functionality late before, but it seems that it's not working. Lynn, any clue? It seems that I'm stuck with the first slide, which is not very nice. Let me check if I can do something else. Lynn, you know how to move it from the slide 1 to slide 2? So I'm stuck with that because I can. Lynn?
Hello, bro.
Oh. Yeah.
Can you just stop sharing and resharing again? Maybe it will work.
Because my keyboard seems to be, or maybe what I can do is I can move the source. If the source is not moving, that's a bad thing. Is that something you see now?
you are at the second slide now.
Okay, sorry. So it's a little bit strange because then maybe I have to go back to the support. But okay, so I will move to the support directly, and assuming that it's moving. For the first part of the course will be of the lecture will be on liquidity, constraint management, position. The second aspect will be on capital management and regulation. Both are quite important. And this is a topic which is not totally finished. And there are many regulators which are part of that. And obviously you have national regulator, but you have also international regulator, because this capital, say, constraint organization is something which was directed by a group of supervisor, a group of regulator located at the BIS, the Bank for International Settlement. This bank is located in Basel, so in Switzerland. So often you will find the Basel regulation, the Basel Committee, etc. But that's the international, say, think tank, a little bit more than a think tank, because they have some capacity to act. And this regulator try to push the adoption of the one standard for all the country. It's a little bit an utopia, but what we can say is that as of today, most of the national regime try to align on one of the version of the Basel regulation. And as you see at the end of the third point, there is a Basel III, which means that there was a Basel I, a Basel II, and a Basel III. But don't be fooled by the number. When they start to have the reform, to venture into the reform, they just label the Basel Committee reform or the Basel Committee regulation. So it's not something which was, say, thought with step 1, step 2, step 3 in order to have a gradual adoption. It was viewed like, okay, they started in mid, say, early 80s, i.e. Something like maybe 40 years ago. And at that time, there were no numbers. So the numbers were the fact that, in fact, the product, the outcome was not that perfect. And then they were obliged to work again on that. So the first session is on bank functions and liquidity constraint. What you have to have in mind is that the bank, as we know them today, they are relatively different from the bank we had in the past, and most of the bank, in fact, changed a lot from what they were in the 15th, 16th century. It was at the very beginning to be able to trade goods and to group some traders, some merchants, and it was far away of what it is today. It's more like a trading group rather than what we have as a bank today. The modern bank was invented by the British, and the role of the Bank of England was quite important. And after say Britain ruling the world, it was the time of the US. And for the time being, they are within the driving seat. And US action on the, say, regulation proposal is very important. And something you have to have in mind is that it's an international regulation, but what is good for US is good for the rest of the world. That things will change for sure, but it's still something which is directed along that way. Then we had I quote the Bill Gates say famous sentence he made in '94, so maybe 25 years ago, saying we need bankers, but we don't need bank as we know them like that. So we need people doing the job, performing the job, but not maybe as an institution as it is today. So that's to say, be careful, there is a huge difference. The main function of bank is to do an intermediation between the saving and the investment. But again, be very careful. In most of the economic models, there is no room for banks. There is no room for, say, entity like banks doing an intermediation. We have had to wait until, say, mid 20th century before having people saying, in our general equilibrium model, we can have a bank, but generally on the model, it's one bank servicing one corporate or two corporate, and then the household as an agent. So it was very primitive, but it's a very important function to channel the saving, usually of household, onto the investment of the corporation. But if we channel bank channel saving onto investment, you see immediately there are two issues. One of the first issue is that if you channel the money toward a corporation, it means that corporation will use it with risk. If you need money, because you need to invest to develop the company. So it could be an investment you have on your balance sheet, but it could be just developing the company, paying staff, doing research and development, doing things like that. But then it means that something which was not the ability of the household, which is taking risk, was intermediated through banks in order to soften, to monitor the risk that the corporate sector is taking. So in most of the cases, the bank is a risk factory. There is a management of the risk, and it's very, very difficult to look at all the sort of risk and also to aggregate them. Is 1 in market risk plus 1 on credit risk equals 2? We don't know. It could be 1 plus 1 plus 1 or 1 plus 1 minus 0.5. So it's something which is very difficult. It looks a little bit simple, but it's a very difficult issue to aggregate the risk. And the other point is liquidity. The household want to have their money. They want to have liquidity guarantee because they do not want to invest for 10 years. 10 years is the duration that maybe a corporate client would be comfortable with. So it means that you have a lot on the discussion about how the bank perform the risk. What is the performance of the risk factory, the allocation of capital, and capital being the saving of mostly the household, even if you have a lot of other economic agent who can save and have excess saving. And then you have a liquidity issue because the client, the household, the non-corporate sector want often their money at disposal to have the money easily, or at least a part of the money easily available. So it means that a first function to that intermediation is you need to have a risk department and you need to have an asset and liability management department. So ALM, asset liability management, would be a key issue for banks. And you could have banks doing good job here or bad job, and it will be very important on the future and the performance. Then bank intermediation, it's nice, but if you publish everything to everybody, you will have all with a full transparency. You will have all the rumors, all the noise, all the information running, saying, hey, you know, the bank invests in this project is not very, very good, and so we want to take our money back. In order to soften, to smooth a little bit the process, there is a lot of opacity. So that means that it makes the analysis of banks a little bit hard, because you don't have, like, say, a cement company or an oil company. You know the price on the market, you know the quantity, you know where are the plants, you know where they drill oil, etc. And you have an idea of price and volume. For banks, you could have an idea of part of the volume, loans, deposit, etc. But it's very difficult to know the price. You know the yield of a loan in certain area, but it's a very fragmented market, and there is nothing like an international price for a loan, apart from, say, very large corporation. And then it means that if we have that, it means that we have a lot of cross-subsidy. So you could have a project not working very nicely, but you can offset that by another project working nicely with the same corporate. So you can decide to allocate the resources to different products, some of them with low profitability, low return, and some of them with higher return. So this is something that normally investors hate, and that creates an issue about the bank valuation we will discuss later, because if you have not a full visibility, transparency, disclosure of what the bank is doing, then it creates issue for outsiders. And accounting is usually a good way to put outsiders and insiders at the same level of information, but not in that case. So that's a topic we will discuss also. And then on financial intermediation, you have something quite important, is the fact that the bank are, say, creating the money. This is a question which is often viewed as the gold standard. The Bank of England has some reserves, some gold in the vault, and then they create some loans and some capacity to make the borrowing to the corporate sector, but then to the merchant, to the traders. But then it's guaranteed by the gold. And today you don't have that. You don't have really a gold guarantee. None of the currency are, say, freely exchangeable in gold at a certain price. It used to be the case with the US dollar being the anchor of the system, but after 72, 74, this thing disappeared because there was a fixed parity between the US dollar and the gold, and this is something which vanished and which is not no more the case. So banks are creating money because they allocate the saving onto the loans. And what will a cement company do with the money? They will pay the staff, they will pay the suppliers, they will pay the tax authorities, the local authorities. So the money will move onto the economy like a flow. So it will be a flow of money going on to that because the bank decided to allocate that to a cement project. So this is the real creation of money. And there are a lot of debates saying, why should private banks be allowed to create the money? Shouldn't be a competence only for public bank or state bank? So there is a debate, and from time to time there are, say, discussion about that. Obviously, when banks perform badly, when we have banking crisis, a lot of people say, oh, look, they are not very good, so we should not allow them to do the creation of money, the allocation of capital on project. We should reserve that to the state and not to the private initiative. So from time to time, it's a discussion. And then what the banks are doing is that the projects obviously are long-term, the savings are often short-term. So there is, as we say, a maturity transformation. And then the banks are doing a lot, say, of additional services, and they certify a lot of the transaction, and they monitor a lot of the transaction, the payment. So in a sense, the main asset of a bank is the trust you can have in. If there is no trust, there is no bank. And it means that this intermediation function is, and the trust is a key issue. Well, now, after a couple of years, far from 2007, 2008, the confidence, the trust within banking sector is at a high level. It was not always the case, and it's a quite important topic to review and to follow. Obviously, you can do the banking activities outside of a bank. You can do some what we call non-bank finance. So it depends on the regulation on the different countries. But you could have, for example, a platform, a crowdfunding platform, putting in contact savers and investors. It could be for real estate project, consumer lending, and I saw that in Vietnam there are a lot of platforms like that, as in Europe or in the US or in Latin America too, whatever. So you have the development of what is called direct, but it's not so direct because those platforms have an intermediation cost, but it's a different intermediation. Then you have entities like hedge fund, so that the funds which are investing and taking bets without that much regulation, and they can in fact take some loans. They can purchase private debt from corporation. So it's something which is very close from the bank mission. And you have the same for private equity. You could have the same for money market funds. It's less and less the case, but it used to be the case. And so you have a non-bank finance. We can say, doing the opposite, that bank has a non-market finance. And due to the US importance, anything which is market is viewed as better, superior than non-market. So there is a lot of difficulties in the regulation, because you can have a temptation to go for market at any price, and then that could be quite difficult and a source of instability. Then it could be a state-owned bank. It's not only a state-owned entity. It could be a community bank or a mutual bank. In Europe, you have a lot of mutual banks, so it means that they are not banks with shareholders, but they are with members. So each member will have one vote, one member, one vote, whatever is your detention or shareholding or holding of the capital. So you can have, say, 5% of the capital, but because you are one person, you have one vote. Often those companies tend to be, in fact, managed by the management, and maybe the governance, the counter powers are often quite low, but sometimes it's working nicely. And you have a lot of community bank. It's something which is most spread in the US. There are 5,000 community banks, often with 2 or 3 or 10 branches, and just operating on a local market. So they know the client, they know the market, etc., etc. And then the activities we have of the bank could be mostly followed on the financial statement, but you have to be very careful, because a lot of the activity of bank cannot be anything else from a bank. So if a bank want to be also a cement company, today it's mostly impossible. Maybe a cement company can have a bank inside, or a group. You have had such grouping in Japan in the late 80s, 90s. You had group like, say, Mitsubishi, Sumitomo, with a lot of activities within the group, of which the bank. It's less and less a possibility, an option, and banks should be with a narrow focus on banking activities. Obviously, bank could have an insurance activity. They could have real estate, because it's supposed to be very close from the banking activities. And I remember, say, 30 years ago in Brazil, the bank from the state of São Paulo, Banespa, had within the bank a transport company because they wanted to help the workers to commute. They have a coffee company because they want to supply product and food product to their workers. They had a housing company, a property developers, but that was something not very nice, and the regulators now forbid most of that. But still, you can have some activity depending on the regulation. So if we look at the balance sheet, so I advise you to be on full screen because I suppose that it's impossible to read it. So I will try to put it on full screen. So I don't know if it's helping you. But you have here the balance sheet, the first part, which is the part on the left, which is the asset part. And you see that this bank has roughly 3 trillion of assets. It's a bank which is quite big in Asia. You know which bank it could be? A big bank in Asia. You can chat, raise hand. Any idea? So if you have problems to see the file, okay, thanks for the ADB answer. No, the bank with 3 billion is HSBC. So it's a big bank, 3 trillion. So it means 3,000 billion of dollars. And you see for a bank, ICBC would have even maybe a bigger balance sheet, you're right. And but this one is still a big one. And I wanted to show you because they have something which is quite nice. What is the percentage of loan and advances to customers on the total? You see in the middle, you have loans and advances to customers just after banks. So it's 1 trillion. So 1 trillion on 3 trillion. That means it's loans at, say, I put it roughly, loans at 33%. So you see, then the question is, if a bank, we just say that banks are doing loans, why we don't have more loans here? And you have a part of the answer if you look at the details of the balance sheet. You see what is the very big balance sheet position. You have something which is cash, which is 300 billion. You have something which is financial investment, 400. You have something which is trading. So in fact, on those, and you have a non-trading repo. The repo are a way to borrow money from one other bank and to deposit the security and to repay this loan on a very short-term basis, often 1 day to 1 week. And it means that the rest of the balance sheet is the management of liquidity. So we say the two functions are moving saving onto loans, in a sense, onto investment. And the second function is to manage its own liquidity, because they do not want to be short of liquidity and to be in trouble. So here, it means that you have a huge part of the balance sheet, maybe as big or bigger than loan, which is in fact linked to the liquidity management. And this is something which was not that obvious if you look at the balance sheet of HSBC, say 10 years ago. Then the other part is the part which is in fact linked to the trading, but you see the trading is only a limited part of the balance sheet, 300 billion. It's still big, but that's 10%. So it means that a bank like HSBC needs to have a lot of liquidity in order to secure the balance sheet, the capacity of doing the intermediation of loans. And if you look now at the right part, the liability and equity, you see the deposit, the customer deposit amount to $1.6 trillion. Here, it's roughly half of the balance sheet. And it's something which is normally more important than loan. It's not always the case, but it's more orthodox to have that. But at the same time, you see there are a lot of short-term debt which is linked to the management of the liability, and you have also some long-term debt, and you have equity. So equity is a part which is provided by the shareholders, and so we have something like, say, 7%, 200 billion on 3 billion on 3 trillion, sorry. So we have something like 7%. So if you think about 7% being your business or a normal corporate, it looks a little bit low, but that's something we will discuss later. Then you have another bank. You have a Vietnamese bank. You see the total balance sheet is 1.3. Now it's in trillions of dong. And the main row is loan to customers, and here we have something which is over 50%. So it means that if you are not a huge international bank, you will have less pressure or less need to manage your liquidity because you basically operate in one system. But it's not totally the case. I don't know if you recognize the bank. Any clue? No clue. It's a Vietnamese bank, and I suppose it's one of the biggest. So sorry, it's bank, not band. Well, I could have selected another one for sure, as Nguyen Hong Bui mentioned. But it's to say that if you are a bank operating in mostly one country or one area, one region, most probably your loan book will be a bigger part of your total balance sheet. And if you look at the liability, you will see here that the deposits from clients are a very significant part. Deposit from customers, it's 1032 on 1326. So it means that it's say over or above 2/3 of the resources. So which is quite impressive. In that case, for that bank, you can figure out, okay, they are collecting deposit and they are doing loans. But for HSBC, it's not that totally obvious. Then what we have in balance sheet is that we have, okay, intermediation, loans and saving. We have the liquidity buffer management, the cash, the thing like that, the short-term investment, and we have the trading position. But you see, it's a very limited set of information. However, normally, the information we have should be supplemented by appendices information which explain more the maturity and the quality of the saving and the loans. You see, we just have one line saving deposit. Are there demand deposits, saving deposit, term deposit? Are they coming from household, from corporate, from institution? We don't know. Are there the term deposit for 5 years or just for 3 months? So you see, there is something which is quite difficult to read on a balance sheet. You can read a minimum sort of thing, but you cannot dig really further in order to appreciate the quality of the bank. But then this is something which is provided a little bit later. And then something we look at on the balance sheet, which is an easy one. I don't know if you can see very well the ratio, but you have the ratio of the loan to deposit. And here you have the yellow curve, which is HSBC, the blue line, which is JP Morgan, the biggest American bank, and you have BNP Paribas, which is the biggest European bank, in purple. So you see, they are very different models, but the trend is to have a loan to deposit below 1. Because if you have more loans than deposits, it means that you have to find money, and who will provide you the money? Where you will go for looking for additional money? Imagine that you have loan 120 and deposit 100. You need 20. Where you can go to balance your balance sheet? Any clue? It will depend from your organization, but one possibility is central bank. But if you go to central bank, usually they will ask you to have some guarantee. They will say, okay, we will let some then we will let something. So you can, and you're right, you can issue shares, you can issue equity, but the most normal is the interbank, or what we call the money market, depending on how your market is organized. You could have or a market for the short-term fund just organized between banks, then it's only an interbank market, or you can have on that pension fund, insurance company, money market funds. You can have foreign banks doing that. So it means that you go to the market. But if you go to the market, it means that you are dependent from other institution wills. So if the other institutions say, well, I do not trust that much this bank, then you will face a lot of issue, because you need still to fund your loans with resources. And if you don't have enough resources, enough deposit, then you will have to reduce the size of your balance sheet. So you can say, I will stop a little bit to be active in that or that market, but it's never very nice, because if you exit a market, you not only you lose the face, but you lose the clientele, and you lose the revenue associated. So it's often very bad to be obliged to shrink the size of the balance sheet, and because it's linked to your revenues. But here you see on that slide the traditional US model was to have a loan to deposit much below 100%. And due to the COVID crisis in 2020 and 2021, they are below 50. So it means that they have 50 of loans for 100 of deposit. So it's a huge pressure. They are very, very liquid. And when the banks are very, very liquid, it means that the economy is also very liquid. And then you have issue about speculation, especially if the rates are very low, which is the case of today in a market like US or Europe. And then because you have a lot of liquidity with low rates, then you have a search for yield, and you have temptation to go for cryptocurrency, property, to do to some specific assets, some specific sectors yielding something. I was quite impressed to see that the yield offered by the Evergrande Renda property was that they were with a lot of difficulties to repay to retail investor. It was yielding 11 or 12%. So when something is yielding 11 or 12, it's maybe in today's world that there is something, there is some smoke behind that. So you see, it's something which is nice to have, but be careful. If you don't have enough deposit, you are could be in difficult position. You see, BNP Paribas used to be at 120, 130, and then with the on the past, say, 20 years, they move to something which is normally viewed as more normal, more orthodox, which is 90%. But we have example of bank with higher loan to deposit. That's the first thing. The second thing on the financial statement would be to look at the profit and loss. And on the profit and loss, you have two parts. The upper part is how the revenue is constructed. What are the contribution from net interest income, the contribution from fee and commission, the contribution, sorry, of trading, and, for example, the contribution of insurance and things like that. Usually, a huge part of the revenue is made by net interest income. Net interest income is the income, the yield you have on your asset, with the volume of your asset, minus the yield you pay on your resources with the volume of your resources. So it's normally something which is purely financial intermediation. And I suppose that NII, net interest income, is a bigger contribution for Vietcombank than it is for HSBC, because we saw that the purely loan and deposit is bigger on the Vietcombank rather than HSBC. Then the indicator to look at the NII is often to look at the NIM, net interest margin, which is the NII plus dividend. Sorry, the dividend is the sign plus is not so often, it's plus dividend, divided by interest earning asset. So anything yielding a rate would be sample gathered, and then you will make the ratio between your net interest income and the interest earning asset. And you will follow that, and that's something quite important to follow. Then fees and commission could be many businesses. You will have that for asset management, you will have that for payment, for brokerage, for advisory. So it's a broad range of businesses. And then obviously you have insurance revenue, and you have the trading. So if you look at something which is quite sorry, not this one, but quite nice, we will come back to the previous slide. It's the net interest margin. This graph is taken out from the Federal Reserve, say the Insurance Deposit Corporation, the FDIC, and they do a computation each quarter of the net interest margin on the definition we use. And you see here something happen which make the blue line, the NIM for the large bank, moving down sharply. And then if you take the smaller bank, the black line, it's moving down, but not as fast as the blue line. You know why in 2020, 2021, or maybe the first part of 2020, the net interest margin was going down that sharply in the US? And that's a sample of all US banks. Any clue? What is the event which could drive the net interest margin down? You have a couple of say driving factor, but okay, so that couple of answers are coming, but I cannot see them yet. So maybe it's my screen, but I cannot see your answer. So I'm sorry, but well, okay, whatever you put. So I suppose you put a lot of good idea. And I'm sorry not to be able. Okay. In crisis time, the margin is higher. Well, that could be partly the case, and you see that in 2008, 2009, the margin was up. Yeah, so that is a good point. Saying in crisis time or just after the crisis, the resources are more difficult to obtain, and then the bank say we have less bank, so same demand or more demand because the crisis is over. So then you have a supply demand effect and the margin moves up. Here, 2020 and 2021, the margin is down. It's a COVID crisis. Obviously, the pandemic is different from the 2007 2008 crisis. But then here, it's because the rates, specifically the short-term one, were down. So because of that, because the margin, if the rates are moving down to say 0%, you are making much less money on deposits. If imagine that you have a deposit, you pay 10 basis points, the rate are going to 0. You stop to pay 10 basis points to your deposit, but you don't make any margin on your deposit. So then the big issue is that deposit margin move to 0 or close to 0. And this is something which is a huge part of the net interest margin in normal time. When you have an interest rate, say at 4 or 5%, imagine 5, then obviously if you pay the deposit 1%, you make the gap between the 5% on the market, you can replace it, and the 1% you pay to the depositors, to the savers, is on your pocket. So 5 minus 1, it's 4%, it's nice. But if market rates are 0, then if you pay 0 the depositors, they are not very happy, but that's life. And but you make no margin. So what you have to have in mind is that this margin is in fact built with a deposit margin and a credit margin. And then within the periods of low interest rates, this deposit margin is totally moving down and often disappear. In Europe, there were a lot of discussion about making the client paying for depositing. So it means that if you deposit 100 on a normal bank, maybe in some cases the normal banks say, okay, because the rates are negative in Europe, I will charge you €1 for a year. So it means you have to pay to make your deposit in a bank. You will not receive the thing. So you see, this is very hard. But in Germany, which was a country with the biggest negative interest rate, because it's Germany is supposed to be the safe part or the safest part, the lower risk in Europe, then the rates were pretty negative. And it means that with negative rates, the bank were charging the corporate client, at least 2/3 of them, if they deposited money within the bank, they will have to pay a commission, in a sense, or we say a negative interest rate. For the retail depositor. It was only for the very rich people above a threshold, above a certain level, but it was maybe reaching 5–10% of the depositors, no more than that. But you see, it's something weird, something very difficult. Why the bank will charge somebody to deposit the money at the bank? So this is something which is quite significant in the evolution. And here, back to the previous one, you see this is a profit and loss account, or the consolidated income statement of HSBC. So you have 3 years, and you will see that the total revenues, which is the last line here, is something which is 50 billion. It's going down from towards the level of 2018, 2019 to the level of 20. But you see the net income coming from the net interest income, interest expense is roughly making 50%, around 50% of the total revenue line. So a little bit higher than 50%. So it means that this is something very important. If rates move down or up, it will have a significant impact on the revenue line. And depending as a function of that, you cannot always adapt your business model to high rate or lower rate. So it means that if you make less money because rates are going down, then obviously you have to find a substitution or additional revenue or less costs. We will discuss that later. And then you see there is a complicated way. Maybe you can see that on insurance, there are insurance revenue minus insurance claim. But then the idea is that insurance revenue is at the premium, insurance claim, that's what you pay. At the same time, insurance revenue are invested within the bank and producing net interest income. So you cannot make net insurance premium income 10.093, deduct 12.645, and say, hey, they are losing 2.5 billion on insurance. It's the first view, but the first view is wrong, because with the insurance premium they invest in say in different assets, and often long-term assets, because insurance premium are covering claim for long-term. Obviously, you have some short-term like motor, but life insurance is much longer. So here you have now the second part below the revenue line, and you have the movement between the top line, the revenue line. It's often called revenue, but you can find operating income too, which is very British wording. And then you go from that top line to the bottom line, which is the net income. And between the two, because the bank are a service industry, often the 2/3 of revenue is cost of labor. And that's very important. Staff, you have a lot of people working in banks, and obviously more and more today you have a little bit more IT and technology spending, technology budget, but the cost income ratio, so within cost you have a lot of staff and IT, we follow that very carefully. The cost income ratio, if you think, it's a little bit as the opposite of an operating margin. If you take a normal company, say a cement company, they made an EBITDA or an EBIT of, say, 400 on a sales figure of, say, 1,000. So then we say the operating margin is 400 on 1,000, say 40%. Here in banks, the bankers are not speaking the same language, but at the end of the day, that's the same concept. The cost-income ratio gives you the amount of costs which they require in order to produce or to generate one of revenues. And then if you take the opposite, the non-cost, the gap between cost and income, that's an operating margin. But in banks, it's not very common to speak about operating margin. And then you have something which is normal in accounting, but which could have an impact on bank, is that the goodwill impairment is often isolated. It's non-cash. It has no impact on the solvency, on capital ratio. We'll discuss that later. And then you have a second ratio, which is quite important, which is a cost of risk, COR. And then we will discuss that also later. And if you look at the second part of the P&L for HSBC, you see on the top line we have 50 billion. At the bottom line, we have something like 6 billion. But you see that here we could have a lot of spending. You see the employee cost, you see the thing, and you see in the second year, in 2019, you have a huge amount of goodwill impairment, depreciation, so 7.3 billion, which explains the movement from 2018 15 billion to this 8.7 billion. But you see the profit are going down because the top line is going down too, and even if there is no goodwill impairment. But we will discuss how we look at that. The big thing we have on the balance sheet, we say, is to have a view on the intermediation, but the intermediation we have on the balance sheet is not enough detail in order to have a view. So usually the bank are providing things like that. So here you have the asset and you have the liability by period. So in the next 14 days, in the following 15 days, i.e. 1 month, then 1 month, 3 months, etc., etc. And we will pay a lot of attention to this liquidity gap, because if you have a company like that, it means that you have total asset much below the total liability. So it means that on the next 15 days, 14 days, you will have to repay, to cash out something like, which is 137 billion, and then you have only 88 billion of short-term investment coming in, or loans coming in. So you have a gap, which is something big. Obviously, you see there is a line which is the time deposits, and the idea is that maybe your time deposit will roll over and you will be able to resell some of the time deposits. So if you have an assumption saying my time deposits are very loyal, then obviously the problem is not 48 billion, but still minus 18, which is still a big issue. So then when banks have not enough money in order to repay the short-term demand of the client, and you have bank panics. This one is a Bank of East Asia, but one of the most famous is the one on the Northern Rock. So I will try to copy that link and to pass it to you. Okay, and then to do that here. I hope it will work. So it's a short video.
Hello and welcome. Thousands of Northern Rock savers have queued for hours at branches to empty their accounts. Many more have withdrawn cash via the internet. Despite reassurances from the bank over the safety of their savings, customers have now taken up well over £1 billion. Many failed to access online accounts because of the massive demand. Branches were forced to extend opening hours. Our business correspondent Rory Catlin-Jones reports.
For 36 hours now, they've been told their money is absolutely safe.
The Bank of England would not have lent us any money if we were in an unstable financial position. It's as simple as that.
But at branches right across the country, Northern Rock customers have been queuing for hours to take their money out. Everyone from the Bank of England to the Chancellor has been telling them that there's no threat to their safety.
It was a bank with around 1 million clients, and the estimate was on that day when the rumor was that they were not able to repay the short-term liquidity demand, the saving of their clients on demand. There were around 20 to 25,000 people queuing close to the branch.
But that doesn't appear to have made any impression.
The Chancellor has said, don't panic.
So did the captain of the Titanic. That went down.
I'm not panicking, I'm being totally rational. I'm just moving my money somewhere else.
So you see the client say, I want my money back, and I do not trust what say the politician. Politicians say, don't panic, the money will be there, Bank of England will supply the money, and they say the captain of the Titanic says the same.
This is also a crisis for internet banking. Miranda Hall has been trying and failing to get access to her Northern Rock online account since Thursday evening. The bank says its website is now working a bit better, but this customer is having second thoughts about banking online.
I have no means, absolutely no means at this moment in time of accessing my money. And that for me is an uncomfortable place to be. Very uncomfortable, actually.
So what exactly is happening to Northern Rock's deposits? There's £5.6 billion in branch accounts, about £4 billion on the internet, and nearly £10 billion in postal accounts. By last night, around £250 million had been withdrawn from branches, with £750 million gone from online accounts. More withdrawals will be arriving in the post, and of course...
And the interesting thing on that numbers is that they were very short-term numbers. So you see the numbers look more or less big, specifically for internet. So say 750 is a lot on say 5 billion. But the on the following day they were more or less the same, and then the government was obliged to intervene and to say, okay, we will guarantee all those deposits. If not, all of those funds will have been withdrawn in say a couple of days.
A lot more money has gone out today. But even in the unlikely event that everyone withdrew their cash, the Bank of England's money should be enough to keep Northern Rock afloat. But tonight the Chancellor weighed in with more assurance.
I appreciate there have been difficulties with the queues and with the internet, simply because they're not used to dealing with this volume of business in the normal run of events. But the point is, if people want to get their money out, it's there because it is backed by the Bank of England. I authorise the Bank of England to provide that support because I think.
And you so you say, I authorize the Bank of England to do that because it was not according to European rule at that time. It was not a compulsory obligation of Bank of England, and normally the bank could bankrupt. But because of the panic, because of that, he is very quiet. The Alistair Darling, the Chancellor of the Exchequer, the Minister of Finance at that time, he said, we want to avoid a panic. So we decided to support the bank, and the bank was a small bank in the UK banking system.
It's important that we should maintain the stability of our banking system.
Those who didn't get through the doors today will be back on Monday morning.
The staff member was about to put their hand up. Is there as a cut-off point? Anyone behind that member of staff, I'm told, will not be able to be served today.
It's shareholders, not savers, who will feel more pain next week. Northern Rock is almost certain to end up in the hands of a bigger bank. Any buyer will only want it at a bargain price. Rory Jones, CNews.
And we've had hundreds of emails from you on the subject. Ian Phillipson from Essex says, I have a Northern Rock mortgage and I'm not worried in the slightest. This is a ridiculous panic created by uninformed journalists, and it may end up costing people their jobs and their livelihoods. B. Brown from Hull says, I'm surprised at the reaction of the public, as the feedback has been that your cash is safe. Once again, our media has created mass hysteria. They're at fault for exacerbating the situation. David Cole from Tunbridge says it's okay for people to stand on the sidelines and criticise investors as sheep. Of course, they're withdrawing their cash, but I can't blame them. I've suffered at the hands of several financial institutions in the past. Good luck to those people. And Raymond Whitehead from Inverness says irresponsible and greedy banking practices worldwide are at the heart of this calamity. Our erstwhile Chancellor, not Northern Rock savers, should be held to account if our...
You see here, you have something which is very British. It looks like a very difficult situation, but you see the people were queuing quite in order, without any big trouble, without shouting. And at the very beginning, the first videos were a little bit different, but this one is showing people queuing very normally with a lot of people in the bank. So it's maybe just very British.
Economy now slides into recession, which is more than likely. Send your emails and you get much more information, analysis and advice on the crisis at Northern Rock by logging on to a special web page. It's www, of course, and then bbc.co.uk.
And you see the dates of the day at the BBC News was 18th of September, the 2007. So it was one of the very first bank to bankrupt during the financial crisis. So it's something which was very, very specific, idiosyncratic, and we will look at that a little bit more in detail. Okay, now if we move back to that, I'll try to move with the next question. You have 3 pages with one set of questions, and then you have so I will try to move that back to the document. Okay, so here we are. Not sure you can see that. Okay, no. So you have 3 pages. The first one is about the question on Northern Rock, and the page 26 and the page 27 are information on Northern Rock. So the first question I would like you to look at is to look at the loan to deposit ratio in 2006. And then the second question is to look at the information provided. Where is the loan portfolio, and what are the liquidity gap short term, 12 months, and long term after 5 years, and how you feel with this model. So you got 5 minutes to look at the information, and I will discuss with you question by question in 5 minutes. So you have the maturity picture, and then you have a couple of information on the activity of the bank. I will let you 1 additional minute or 2 additional minutes. Maybe we'll move at 8:17. So it's a bank we just taught before, which was the object of the video, with the panic and the special treatments by the UK authority. Question 1 is the easy one. What is the loan to deposit customer only ratio? You can answer on the chat or raise the hand as you want. It's normally not something very difficult. So no answer. Nobody brave enough. Say 1 speaker would be okay. Say the loan to deposit. It's not 40-42. You have if you look at the loans of Northern Rock, you have loans which are in total 86.4 billion, and yeah, I guess an answer around 3 times is okay. And don't we to put the right, sorry for my pronunciation, put the right answer. The answer is you have 86.4 of loans. Oh, sorry, I put the wrong one. 80 as for loans, and at the same time you have deposits, clients deposits 26.9. That's deposit. So it's drive you to be roughly 3.2 times. Yeah, you see, you have 86 of loans for 27 roughly of deposit. So this is not something which is very safe on what we said earlier. We say that if you have something a little bit above 1, you could face problems. But here we are not above 1, we are above 3 times. And it's also because they were very they were very confident on their capacity to issue a long-term resource. And you see that the long-term resource they have is something like debt security in issue. If you take the last column, the column which is total, you have 64.3 roughly. So it means that they will depend a lot on securities issued. But securities issued, it means that it's fine. but till the market are normal. If there is a smoke signal and if the trust is lost for any reason, it's a very, very dangerous situation, because it means that you cannot balance your loan, which is long term. Look, we will discuss that, with the resources. And the second question is about the company. Apparently, the liquidity gap. The second question, where is the mortgage? I was moving too quickly. Where is the mortgage loan portfolio? Well, that's something I will answer. The mortgage loan portfolio is here. Its mortgage are often 10 years, 15 years, and there are loans and advances to customers. And you see, if it's 77 billion, it's the bulk of the 86. So if it's the bulk of the 86, it means that a lot of that is long term, and if effectively after 5 years or between 1 and 5 years, you have something which encompasses a lot of the mortgage portfolio. And then if you look at the question 3 and 4 are linked. If you look at the, say, apparent equilibrium, apparent balance, this company has more, say, short-term liabilities and short-term equity, which is what we say something dangerous, because you will have to repay your any resources which end up in 1 month. You have to reinitiate that, and that's something which is very dependent on deposits from customers, very short term, 3 months, and the resources provided by security. At the opposite side, they have a lot. If you take the 5 years, there is a gap of 30 billion. So you see, this is something which is not very balanced, and which is not very balanced in terms of loan and deposit. So if we look back at the weakness of this bank, and you can have an idea of if you read the blah blah on the page 27, you see they explain that they have mortgage-backed issue, and that they are doing a lot of securitization. We will discuss securitization later, but what you have to know for the time being is that they issue debt, and they issue debt regularly with the assurance that a part of the cash flow of the mortgage will pay the debt, the security. And they are transparent because they show the amount of securitization, but the model itself is a model which makes a lot of risk onto the day-to-day management, because you see the amount of new flows they have in 2006 and 2005. If for any reason the security market closed, and that was what happened in 2007, there were questions about the mortgage, the real estate market in the UK as in the US, then suddenly the market was closed. And if the market is closed, it means that you are left with a lot of resources to refund, rollover, and you cannot. So it means that these people with short-term deposits will claim their money back, and you have no access to that. So it means that you are bankrupt. So what happened to Northern Rock was a model where loans were much bigger than deposit, but fortunately we can see that. So it's a good disclosure, because they could have, say, part of the loan book is out within security, so we strip out part of the security, part of the mortgage book. It's not something they were doing so good, but at the same time the model was not balanced. At any shock, any issue, everything was falling down like a card game, card castle going down, because you have some wind on the financial system. So due to that, it was something which was very difficult, and then the bank's regulator, supervisor, tried to change the way the bank were authorized or incentivized to manage their liquidity. So this is something which is quite a big event, and in UK they have had a specific regulation just on that, because the bulk of the crisis happened in the UK. Here you have just an information saying that in fact in most of the systems there is an insurance scheme. I don't know how much of the deposit are guaranteed in Vietnam, what is the threshold, but in the US, if I'm not wrong, it's 200K, and in Europe it's around 100 euro, 100,000 euro. So Europe, it's sorry, Europe, it's 100K euro. How much is that guarantee in Vietnam? You know? Anybody has an idea on that? If you have a deposit on a bank, if the bank has trouble, what is the amount of money you are sure to recover, even if for any reason the bank bankrupt? Any clue? Thanks, Ran. So 50,000 dong, that's is that in USD? Okay, so then it's much smaller, but it should be proportionate to the, say, GDP level or whatsoever, and to the capacity of the system to weather that. But in US you have the deposit insured and the deposit not insured. Okay, thank you for your contribution. And so that's just to show the fact that the FDIC has a reserve and ask the bank to maintain, to put some resources on the reserve if the reserve are used. But the ratio is reserve on deposit. So if the deposit increase a lot, which it was the case at the end of the graph, then obviously the ratio is going down. And then the US are very pragmatic, and they gave so 5-10 years for the ratio to be above a certain level, if I'm not wrong, not to go below 125, and then to move up. So it's something which is important, because it's create a trust in the banking system, saying that the bank puts the money in a common pool, and this common pool can help the bank to survive. But you see, this common pool is not too large. In the US, this common pool is around $110 billion. $110 billion. It's something which is able to save a couple of small banks, but you cannot save a large bank. The JP Morgan deposit is higher than 2 trillion US. So even with a huge amount of money like $116 billion, you cannot save JP Morgan depositors. So you can do a couple of things, but not the big one. So then the issue would be how you deal with the big one problems. And then a lot of the bank try to say how quickly my resources will dry if I have no production and no access to additional fund during a certain period of time. Here you see that's a bank called RCI. It's a car loan company, depending on Renault, and they have a gap, and they say we want to be comfortable and to be able to weather the market circumstances without issuing new resources. So it means they need to have a lot of existing liquidity line in order to support that. And I want to finish on that, and then we will make a break. The one thing we talk about deposit rate moving down when rates were going down, we have the same thing when the rates move up. So it's something which was the case in US until 2019, but then it's reversed. With the rates going on, then the rates of the deposit are moving up. And the elasticity, the behavior of the rates versus the market rate. So if market rates increase by 100 bips, if the deposit rates increase by 30 bips, we say that the deposit beta, the beta being the relationship between the 30 and the 100, how much of the market increase you pass to your client. And often this is a low number between 20 and 40 for on the 12 month, 18 month, 24 month for individual customers. And this is a high number, a much higher number for the corporate client. But the example of rising rate in the US were mostly 2018, 2019, and the previous example was 2004, 2005. So you have some ideas, some experience of what is the deposit yield behavior, this beta, but it shows that when rates move up, banks are better because they do not pass all the increase of the market rates onto the depositor, meaning that they create a margin. Yeah, so it was a little bit what we saw on the net interest margin on the previous chart, because obviously we have this supply and demand, but as an exit of the crisis, rates were moving up a little bit. So it was a mixture of that. So I propose you to stop a little bit, and we will be back in 15 minutes to discuss the ratio. Thank you. Enjoy the break. So we'll close the break in 2 minutes. So we will start again, and so we no, maybe 1 minute. Sorry, I mentioned 2. I should give you an additional minute. Okay, let's start now. All this section was about the analysis of the function of the bank, the intermediation, and then the translation within the financial statements, mostly the balance sheet and the statement related to the balance sheet, which give you an idea of the time framework. So this is something which is quite important in the analysis, and due to the fact that the couple of banks bankrupt in 2007, 2008, because they had much too high loan deposit ratio and much too unbalanced liquidity gap on the short term, as the example of Northern Rock. The regulators worldwide, and the one inspired by the Basel Committee, but also under the influence of the British regulator, the Bank of England. The Bank of England has now a department which is the PRA, the Prudential Regulation Authority, and this PRA is trying to push, to lobby for, say, improvement of regulation, as many other regulators. And during the crisis, Bank of England was very vocal, saying that the model should be changed, because the problems arise a lot in the UK, not only in UK, but there were a lot of problems in UK. So then the regulators create a new concept, which is a liquidity coverage ratio. And this liquidity coverage ratio is quite easy to understand. It's in order to protect the bank on a very short-term period. The idea is to look at what could be the likely outflows of, say, deposits, resources, everything on the next 30 days, 1 month, or 31 days, the next 1 month, and on the coming 1 month, and what are the assets which are liquid and which are very close to the cash and which could cover the outflows. So it means that it's a little bit like a dam. You have to put a level of the dam in order to face to water movement. So if the dam is not, say, high enough, obviously the water will pour over the dam and you will have liquidity issue. And the idea here is to create a category of assets called high liquidity, high quality, liquid asset, HQLA. And this HQLA should be built mainly with liquid asset or with asset without any pricing sensitivity to the current environment. So it means they are supposed to be cash, government debt, because I suppose that in US as in Vietnam, if you purchase government debt, it would be very liquid and depending the status, but you should have no problem if you have a government debt on as an asset, you have a bond on the government security. If you have 100, it's very likely that the value in the next 30 days will not be different from the 100, because even if you have stress, pressure, crisis, it's very likely that the best quality of asset will not move in value. So this HQLA is basically that. There are other assets included in, but each time you include an asset which is liquid, but for which the price sensitivity is high, you will put a haircut or a discount. For example, if you take the large listed company on your country, if they are part of the big index in the FTSE in the UK, in the FT 100, in the FTSE 100, most probably they are very liquid. In the US, if they are Dow Jones, the 30 of the Dow Jones, that's something which is liquid. In Germany, the 40 of the DAX index. So those companies will be liquid, and that's something which is quite easily sellable on the market. But, and that's a big but, you could have an impact variability on prices on 1 month. And then the haircut, the discount, could be 50%. So you have 100 of share of, say, Facebook. You recognize on HQLA only 50% of that. So if you have 100, the HQLA is populated only by 50, by half of that. And then you construct your HQLA. Then obviously the main difficulties is to have an idea of what could be the outflow in 1 month. So what could be the outflow in 1 month? That's something which is very debatable. And so here you have a discussion. You have say categorization of the different cash outflow, and then the cash outflow you will have in different in different category of asset will be very different. So you will suppose that everything with a no say fixed term, so something you can freely get out, will be very likely to get out during 1 month. So it means that if you do that, you have a lot of the funds which are, say, fund with one month duration, 2 months duration, 3 months duration, which are quite say short term. You assume that most of that will get out, and that's the case at the bottom of the table of the page 32. You have any liquidity provided by other customers, not the say loyal customer, household or corporate on which you have a relationship. We assume, they assume in that ratio that there is a cash outflow, which could be, say, maybe 3% if you are something which is very stable. You saw in the Northern Rock, on a panic, on a stress, it was much more than 3% in 1 month. But that's a maximum of a panic. Often, when you had issues about the problem of a bank, I would say that the very loyal customer will move very, very prudently and not very quickly. So they will be slow to move. However, institution, corporate, they will be very quick to move. So we assume that the deposit for which you have a relationship with a corporate, they could they could leave by 20%, 25%, 40% during the month. So here, if as soon as you have such thing, you build something which is a relationship between the HQLA and the outflows. You see here the outflows of Bank of America back are supposed to be something like 16% of the deposit, of the balance sheet, sorry, which is 19% of the deposit for the deposit outflow. And you see, according to the model of the bank, the outflow rates move from something like 17% for a bank with a huge relationship, which was Wells Fargo, a WFC, and which moved up to 48% for banks for which the deposits are mainly institutional, like State Street or Bank of New York Mellon. But even on a bank like Citigroup, where a lot of the deposits are not purely retail deposits, then you have a higher outflow assumption. And then this ratio was introduced in 2013, and it is compulsory now. It was not compulsory at the time of the crisis, and every international bank, because this regulation is a lot on international bank, need to fulfill that and to be above 100. You see, the requirement is to be above 100. So it means that it's a good news or not a good news, but it creates problem, because if you invest a lot of cash on your asset in order to fulfill the HQLA, it's something which is which have some side effects. Obviously, we have different rates environments, but the first question is, what is the rate of cash? Any answer? It's not there is no pitfall. It's a simple and not too weird question. I put the rate. I could put the yield. What is a yield of cash? Any suggestion? No suggestion? So, formal question. Cash yield is oops, sorry. Is cash yield 5% in the US today? So you have to answer on your screen. Yes, no? So you have just yes or no. So for the time being, to answer. A little bit pedestrian. For this time, the answers are not graded. Tomorrow they will be graded. So feel the freedom of not answering all. Okay, I'm not sure. If you have your money on cash, it's something which could not be invested. Yeah, it's something which is staying within the balance sheet. Maybe you can deposit on the central bank. That's still cash. So 8 answer. Well, it's not a. There is no pitfall. Huh? It's just to have your opinion. So I saw that there are still answers coming in. Yeah, obviously you're right, Tran. It depends on inflation, but it's just to know if today the rates in the US say allow the yield to be around 5%. Okay, we have 7 answers. Okay, at 10 we'll stop. 8, 9. And obviously I forgot to put I'm not sure, which is a good point. One more answer. Anybody brave enough in the silent majority? Well, okay, say 10, but okay, we'll stop here. Okay, then, so you saw the thing is that this poll, you say mostly no, and in fact it's no, because today we had in the past low inflation. Inflation is a huge debate today, but if you have no being 44 and yes being 44 and one I'm not sure, so it's still very balanced. And obviously you're right to say, okay, it will depend on inflation, on the context, etc. But the answer today is no. In Europe and US, rates, short-term rates were negative or zero, and that was in order to provide liquidity at low cost, in order to redevelop the economy after COVID. So you see, this is something which is quite which is quite different. But the one thing is the thing that in fact you have no interest coming it from depositing cash. Obviously, if you go to US government security, you will make some yield. But in fact, what happened on those tables here, you see that the you don't see here because there is no split of the HQLA, but maybe 50 to 60% of the HQLA is made of cash. So it means that a bank like JP Morgan had 300 billion of cash yielding 0. So this is a big drain on the profits. So if you don't do that, you can redeploy 300 billion in the business. And you remember that the loan to deposit ratio was low. And the fact, one of the reasons of the loan to deposit ratio to be low is because you need to maintain that cash, that big cash buffer, in order to protect the bank from crisis. So LCR was a good thing for the stability of the system, but it was a bad thing for banks because it was creating something which is a buffer yielding nothing or close to nothing. And then it's a big issue for the bank because it is eating your profitability, because you cannot redeploy your resources, your deposit, onto loans making profit. So this is one of the, say, main effect of the LCR ratio. There are others, we'll discuss that later, but that's the main one. And the bank complain, but the regulators say, yeah, but at the same time you are safe. So now the debate is over and banks are regulated with that. So the only choice they have is what is a balance between cash and government security. And the rest of the thing, you cannot, one of the debate was, would it be a good idea to include gold stock onto this HQLA say box? And the answer was, in theory it could be, but because gold market is not that liquid, it's not in. You could have also some corporate debt, not only government debt, but of very, very high level, very, very high quality. So we'll discuss rating agency job, but that would be the best rating from rating agency. So not everything could be in. Then the second ratio that the Basel Committee include, it's something which is called the net stable funding ratio, NSFR. And this NSFR, again, you should have stable funding, stable resources, and available on divided by stable resources needed or required. So you need to be sure that you compute your needs, and in fact you have more than your needs. And this stable funding ratio was very much discussed about where we should put the line, the border between what is stable. A couple of European regulators wanted stable funding to be above 3 years. And the UK and US say, no, we'd prefer 1 year. So the border would be better to look at the stable funds available, i.e. over 1 year, on the stable fund needed, i.e. above 1 year. So this conception prevailed, and this US conception was in fact adopted in the Basel toolbox. And the one thing is that it's not really on the stress period. The idea is that on 1 year, you don't have the same risk to have a stress of 1 year as you have in the liquidity coverage ratio, the LCR, because on the LCR, on 1 month, you can face stress episodes. And so here, it's more a structural ratio. This ratio is not yet fully defined. It's in the process of being finalized. So it's not compulsory for the different bank to publish it, but it will be compulsory normally next year, depending on the region. The date will be different from US and Europe and Asia and Latin America, but it's something which will be provided to investor in the future. So if you look now to this is an example. Banco Santander, sorry, because the Santander is eaten a little bit by the slide. Banco Santander is the #2 European bank. It's based in Spain. And this bank has a lot of activities in Latin America, Brazil, Mexico, but also in UK and US. So it's a big international bank. And this bank tried to discuss the purpose of the ratio, saying, okay, it's nice to have an idea of what is required for stable funding and what is available. And then they produce this example. And in this example, they say we take our Spanish business, and on our Spanish business, they are number 1, number 2 in Spain, and they have a strong position. And they say on our Spanish retail business, we try to look at this NSFR ratio. We believe our business is okay, is not suffering any problem, any issue, and but if we apply NSFR, and this is something which was discussed in 2010 or 2011, so ages ago, and they say we put our business according to what you say, and then in fact we have total assets of that amount. Then what we need for total funds above 1 year is 123. So the thing is that if you have assets which will stay for over 1 year, like this one on the retail, you see the 70, the weighting is 100, and then you need 70 of long-term, so-called long-term, over 1 year funding. So that's a way to compute your needs, your requirements. And then there is something strange, is that maturity below 1 year, so the 30 here, they say, no, you need to have 85% here, i.e. creating a need for 25.5. So the question is, why 85%? So I can create a poll with why 85%, and we will put you need to be cautious. Here. And a second, B and C. Okay, so we'll try. So sorry for the misspelling. The A is it's better to be cautious. So I prefer to have 85% because even if it's coming to be a cash inflow in the next 12 months, I still believe 85% is better to be cautious. It's because the B answer is because I received the 30, but I will continue to do an activity of lending with the cash. C, it's because it is a simplification coming from the LCR ratio and other management ratio, and D, others. So the floor is yours. So you see, there is a loan book with 70 on 100 being over 1 year. So then in that case, you need a one year funding. and then you have 30 below 1 year, so normally it should be 0. But then, is it better to be cautious and to choose, say, an amount which is prudent, or is it a simplification linked to the LCR ratio, or other reason? Or is it because, sorry, the B, because you will, with the cash you receive, the 30 in the next 12 months, you will continue to make loans? Okay, 7 answer. Should be a little bit more, even despite the late time of the day. $11 answer. 12. Okay, I will close the pool. So B, in fact, B and A are okay, because the real reason is B, because you receive the cash, the 30, but what you will do with the 30? You will go to Australia or New Zealand for vacation? No, you are a banker, you have clients, so the cash you receive, you will use it for another loan. So the idea is that on retail, if you stop the activity, it will be very visible in a couple of time, and you don't know what would be the reaction, the behavior of your client. Your client say, hey, this bank stopped to make loans. It's very bad. I need to find a mortgage and to continue to fund my flat, etc. So why they stop? I will go to another bank and I will move my money to another bank. So you are at risk if you don't roll over the money to your client. You are at risk to lose your franchise. You will lose your license, in a sense, to operate. So it means that obviously the answer A is not that wrong, because why 85 and why not 50? Maybe you can say I will use half of the money I receive and put it there. You need to be cautious, because in retail, the relationship with the client is based on trust. We talk about the trust. So if you disappear from the market, it's quite bad, and it means that you will not be preserving your franchise. And you see on the second block, which is corporate loan, you have a maturity over 1 year for 10, and then obviously you need, because it's over 1 year, you need 10 of resources. And then if you look at the 15, which is the other part, which is less than 1 year, the weighting is only 50%, because for corporate, they have many banks. They could choose, okay, you stop to do that, but I will shop around. And usually corporate have 1, 2, 3, 4, 5, 6 banks. Large corporate had 100 of banks. I saw Hengda having Evergrande having 128 bankers. So if one stop to do the business, maybe other will continue. But you cannot do that for all your clients. You have to select. So that's why you have that. Then property, it's supposed to be long-term. Other assets, we don't know. It's supposed to be long-term. It's a by default assumption. And then you have securities. And if you have short-term securities, even above 1 year, you should only have 5%, because even if those securities are long-term, there is a market for that. So you can sell it very quickly. And if you look at the other part of so I will close the pool. Don't know why it's not that. Okay, don't know. If you look at the other part on the liability, you will have something which will be much more consistent with the LCR ratio. You see the retail deposits, the one which are very sticky. This is you insure the deposits. Transactional accounts, so you make payments for your client. They have a payment account, they have a deposit account insured. Assume that only 15% will flow out. So 85% is stable. For other retail, only 70% is stable. For corporate retail, again, a part is unstable, a part is stable. So you have you have a part which is stable and a part which is unstable. And if you have the most stable resource is equity from shareholders, you have 10, the 10 will stay over 1 year. And if you have medium-term and long-term issue, if they are above 1 year, you will take 100%. So then the big thing is that you don't have enough resources in order to face the needs which are shown on the funding requirements, the 123. You just have 103. So it means that if you want to balance, you need to find 20. What are the options to find an additional 20? What you can do to have additional 20, you can how you can balance this bank for NSFR. So we will move that. Question A. So you have 4 options. So I will try to just check the spelling. So again, you have 4 options. Should you balance the bank with more equity? You remember that equity is weighted 100. So should we add 20 of equity? Should we have more long-term debt security? You see that the medium to long-term debt issue, they are 100% weighted. So should we add 20 of that? Should we have more cash? Is that moving the things? Or should we have more liquid? Sorry, it's not liquided. It's liquid loans. For example, change onto security. You saw that the security portfolio over 1 year was weighted at 5%, the 8 were weighted at 5%, creating a need for 0.4 of a long-term funding requirement. So up to you. We need to balance. You have 4. So you have 4 possible. So more equity or more liquid loans? Any brave answers? So maybe one additional answer? No. Yeah, okay. So I will end the poll now. So we have 8 with more liquid loan change onto security, which is the preferred solution by Santander, and we have more equity, which is correct also. But you see, if you increase equity, you will decrease the return on equity, everything being the same. You have the same bank with more equity, you have less return. So that's not very attractive for shareholders. And more long-term debt is also a possibility. But if you have more long-term debt, you need to invest in the asset side. So you increase the amount of long-term debt from 16 over 1 year to 36. Perfect. But what you do with the 20? With the 20, you have to put in cash. So that's a big issue. So we'll try to share with you. So your answers are correct, and the three possibility, but they have different impact on the profitability. So if I move to that, should I share that? Yeah. So the first answer that Santander provided to the regulator was to say, okay, I will provide you with I will have more cash because I need to, which could be good for LCR, but have more cash because I issue more long-term debt. So if you issue more long-term debt, which costs something, and to invest short-term on something which costs zero, the impact on your profitability is up, stable, or down. Without making any pool. So, what is the impact? The impact, if you raise money at, say, you are a bank, maybe at 2%, not too bad. You raise 5 years at 2%, nice. But at the same time, you invest this amount at zero. Your profit is down. So it's not a good news. Then the second possibility, the second answer was here to do what we suggest, which was to have here under the circle line the amount of to increase the amount of liquid debt loans. You have to transform your loans from something which was not liquid to something which is liquid, i.e. a security. If you do that, you increase the securitization of your balance sheet, and you have not that much impact on your profitability, because to turn a loan onto a security at a cost, but not too much. So it means that the solution is security, obviously, but if the solution is security, it's by the usage of the high dependency of securitization that the crisis came, because you depend on the market. You remember maybe on Northern Rock, a lot of the resources were transformed, were in fact security, retail mortgage security, which are RMBS, retail mortgage-based securities. If you see that acronym, it's not to say it's bad, but it's only the fact that you are a bank and you will depend for anything, so for relationship, for funding, for activity with the security market, which is a market. And as a market, it could be fragile and it could be shocked in terms of stress. So it means that the solution implemented by the NSFR is okay, because you increase the long-term funding, or you increase the access to liquidity, to capacity to have liquid assets, and then you can cash them very quickly. But if you do that, you reinforce something which is a weakness of the system, which is to link too much the bank and the security market. So this is something which was a big issue, and then there were a lot of debates, but at the end of the day, this ratio will be more or less done like that, and so it will move. So I will move to the other one. Yeah, okay, that's the right one. So it means that the NSFR. So you have a lot of positive thing coming with the NSFR, but at the same time, it's creating a fragility of the system in order to link bank and markets. The takeaway you have is that the key thing is that to have a good balance between loan and deposit. So anything like Northern Rock is not sustainable. The quality of that management is really one of the first pillars to be sure that it's okay. If it's not okay, you cannot follow a bank, you cannot invest, you cannot deal with that bank. And then the liquidity ratio are on that way. But the liquidity ratio improves the system, but be careful, it's a huge investment for banks, because the regulator said you will do the liquidity ratio according to my assumption, but at the same time, I will ask you to do it on your own set of assumptions. So then, my last question for this session is: how frequent is LCR computation required by regulators? So the question will be, the answer will be every year. So, quarter. No, do not want to put on quarter. Okay, so now you have a pool. How frequent is the LCR computation required by regulators in, say, US, Europe today? Is it something you have to compute every year, every quarter, every month, or every week or every day to your regulators? What, according to you, would be good for a regulator to monitor the stability of the banking system? For the time being, your answers are quite split. Some additional answers. Okay, apparently 15 answer is not a bad number. Okay, so the answer you put is quarter, month, week, or day, but it was quite balanced, and most of you say on the yearly it's not very prudent. You need to have a higher frequency. Then the very first attempt were every year, but very soon the regulator said no. I should have that on my model and on your model. You should have other assumptions, saying that your deposit will, the outflow will be that. So the regulators say you will maintain two sets of of assumption, the regulator one and the bank one. And then they moved very quickly to a quarterly. And the idea was still to publish the quarterly, which means that you have 1 quarter, if you have problem, to solve the issue. But you communicate to the regulator every month, and now they say no, every month is not enough, so it was moved to every week. And for large bank, the systemic bank we will discuss later, it's every day. So every day, JP Morgan, BNP Paribas, Santander should provide to the regulator the LCR computation. So you see, it's requiring a lot of data computation, a lot of capacity utilization, but the regulators say you should do that. And on the top of that, the regulators say you should do that by currency. So if you are a balance sheet in USD, a balance sheet in pound, a balance sheet in euro, a balance sheet in yuan or in yen or in dong, then you have to provide us with the LCR computation by currency, obviously by the major currency you use. But then it means that it's a huge work to produce that. And it's something a little bit like when you drive a car, you have real-time indication of your speed. And you have real time indication on what about the time required if you need to stop. You are at 80 kilometers now on such road with such car. How fast you can stop and brake and be safe, and if any obstacle arise. And this is really the idea to have a metric which help the company and which help the regulator to be like that. But on the published one, it's only every quarter, because if you publish a bank with a ratio of say 75, it's not very nice, and a lot of counterparty will say, hey, I will not continue to have relationship and to provide resources to that bank, because with 75 they will be bankrupt in the coming, say, 2-3 months. So I do not trust this bank anymore. So the regulators say if you are between a quarter with problems, and at the end of the quarter you should be able to raise extra money, but more and more the regulator asks the bank to provide the daily average of the quarter, or the daily average of the last 12 months. So if you really have problem, it could be visible, and it's an auto-realization prophecy, because you show that you are weak and you will be weaker later. So the regulators say, okay, we can live with 60%. So you remember the LCR ratio here was the minimum was 100%. Sorry, it was too far. So it was 100%, and regulators say you can move up to 60. And with 60%, it's okay, but you need to be above. But you see, if you show at the end of September that your ratio was 75, you will raise a lot of questions. So you can show that, but at the same time, you have to say when you publish your report, your quarterly report, maybe next week or in 2 weeks, you will have to say, I have the solution. Now my ratio is that. So it gives you some time to adapt, but not too much. And this ratio was a big change, because during the crisis, a couple of banks had very low visibility on the outflows. One of the stories about a Belgian bank called Fortis, now part of BNP Paribas, and this bank bankrupted in 2008. And the parliamentary report on the bankruptcy showed that the bank had a very good tool in order to appreciate the outflow at 1 day, 2 days, and 5 days. But after 5 days, they have no clue. So you see, it's a little bit like driving a car, because in many cases, think about analogies with car. It's a little bit like driving a car, and you have the light on, but the light give you light only, say, couple of meters in front of the car, and you are in the dark. You are in the middle of the night, so it's not very safe to drive fast when you cannot have visibility. And LCR is giving the bank, the market, the institution, the investor, a lot of visibility assurance. It's not perfect. There are many weaknesses, many problems with that. But at least it gives a visibility, and it's not the full answer, but it's one of the answers. So that's on the takeaway. This ratio is very important to look at. And obviously, you can live with an LCR of 110 or with an LCR of 150. When there were a lot of issues about market liquidity, the bank were tempted to put the bar higher and to move from 120 to 150. But this is supposed to be an answer to temporary issues. Yeah. So, and each time you build liquidity, each time you reduce your immediate return. So if you drive fast, that's okay for you, but you are a danger for the other one. So individually, it's nice to drive fast. Collectively, it's nice to have people not driving too fast. So this is a balance between what is good for an individual bank and what is good for the system, the collectivity. Okay, so then that was a takeaway. Now I want to share with you a couple of stupid questions. I hope not too stupid. I will share that. So I will share. No, this one is. Okay, sorry, it's my mistake. I was doing something weird. The idea is that I want to share with you a couple of. Yeah, I don't know why the camera was broken too. Okay, so now start to be better. Okay, sorry for the break. Okay, and now I should share. Okay. Okay, sorry. Sorry to be a pain. Is that back to that? Sorry, because I cannot find the one. So I will try again. If I cannot, we will do that tomorrow, but maybe I will try again. Ah, yeah. Okay, should be okay. Okay, that's the quiz 1. So then we will have a series of pool. So question 1. Can you answer the question 1? True or false? Loans are entered in balance sheet following bank officer decision to grant it. Yes or no? Okay. Well, thanks for your answer. Yes, 12, and no, false, 6. No, it's not true. When a bank officer decides to grant a loan or to offer a loan, then you need the client to accept. So if the bank officer say, okay, I give you this loan offer, often you have, depending on the country's regulation, as a client, you have 2 weeks to accept the offer, or you have a certain period of acceptance. So generally, if the loan officer, the person at the bank, say, okay, I give the green light, you do not mark or account the loan within the balance sheet immediately. It's only when you have the answer of the client. So question 2. It's also yes or no. Or deposit making loan. But the reverse would be loans are making deposit. So both looks a little bit possible at first view. Okay, you say mostly yes. This one is a pitfall because in practice, if you have not the deposit, you are not tempted to do the loan as a bank. But theoretically, if you imagine a system, a country with 2 banks, a lot of corporate individuals, etc. If a bank decide to make a loan, and imagine that they have raised money with equity. They have 100 equities, they decided to make 100 loan. This loan, they will provide to the famous cement company. The cement company will use it. They will pay the staff, pay the suppliers, the contractors. The suppliers, the contractor, imagine that it's a closed economy. You cannot move out. You have to stay in your country. Then you are paid as a staff for developing, for working at the cement company. What you will receive wages. With these wages, you will spend the money in say any shop. You will spend the money to purchase things like normal things, housing, textile, etc. And the money, for a time being, the 100 of money will flow on many small drops, small rivers, onto the different agent. And until the agent have a usage for that, it will go to the bank account of the shop keeper. It will go to the bank account of the contractor. So the 100 will be reconstituted as 100 of deposits. Not maybe everything at the same time, but close to, if you think about, say, short-term usage. And the theoretical view is that the loans make the deposit, because if the bank are creating the money, because they decided the loans they want to support, but obviously it's a little bit like chicken and egg. You need to have or hen and egg. You need to have a first resource, and often the way to make a shortcut in that say theoretical discussion is to say you raise 100 of equity, and somebody give you 100 of equity, and then you make a loan, because to set up a bank you need to have an equity. If not, you have no license. So you start with 100 of equity coming from somewhere, and then you put that on your balance sheet, and then you do that. So it's a little bit weird. So I can understand the answer yes, but normally the right theoretical answer is no. It's false, because the loans, the bank are creating the money, and the loans are doing that. Then the question 3 is that good or not to have a loan to deposit ratio below 50%? It's very good and safe. It's a pitfall somehow. Okay, you are okay. I will stop here. You are quite balanced, and the pitfall is that obviously it's safe. It's very safe. Is it very good? It depends to whom. So I guess both answers could be considered, because I would say it's not its fault. It's no, but I would admit that if you have a ratio of, say, 48%, it means that you have a lot of deposits in front of your loans. So it's very safe. It's very good for the system, but it's not good for your shareholders. It's not good for your profitability. It's maybe not good for the society, because you sterilize a lot of the saving you receive, which is not deployed in the economy. So in terms of welfare, there are considerations, but I can consider the split to be okay. Then a question which is a little bit weird on the question 4: are derivatives entered in the balance sheet recognized at their cost? So derivative is, for example, a swap. A swap is a contract on which you exchange payment of fixed interest against payment of variable interest. It could be a swap, you receive dollars and you pay dong, and you have many ways to do that. So it's an exchange of flows, of financial flows of the future, and it's you have derivatives because you want to protect your balance sheet, or because you want to speculate. You believe that fixed rate will be more attractive than variable, so you want to receive the fixed and pay the variable. Or you believe that the dollar will be more attractive than the yen, then you expose yourself to dollars and not to yen, and you exchange a flow. Some hesitation? Some additional hesitation? No. 19. Well, okay, I will close here. So you say mostly wrong, which is okay, because you see, what is a derivative? It's an exchange of future cash flow. You cannot exchange something which is not balanced at the time you do the operation. So if I say I want to exchange my shirt with your food, I need to believe that the trade is okay and that the value of my shirt is equivalent to the value of the food. Well, that's a very stupid example, but you need to think that there is a balance at the time you do that. So the value of a swap at the beginning is 0 because you have a balanced agreement. You have a balance between the value of the shirt and the value of the food. So it's 100, 100 plus 100 minus 100 is 0. Obviously, later on, maybe the food is not so good and the shirt is better, and then the value is negative because I exchange my shirt against the food and the value of the food is going down. So you can think a lot of things about the derivatives, but think the derivatives being the right to receive a cash flow, a future flow of cash flow against another one. So that's often the idea. You could have many different derivatives, but the principle is that they are recognized at the market value. And the market value is 0 at the beginning, but then the day after, the minute after, the thing will move. Shirt and food, not that much. But if you think about yen and dollars, short-term rate, variable, fixed rate, you will have a lot of changes. We will not do the number 5. We will do the number 5 later. So then the question 6 is also yes or no. So the question 6 is, after LCR, the banks stop to make loan to each other because, in a sense, if you make a loan, a short-term loans, if you receive a short-term loan from another bank, it disappears from your stable resources. It's an outflow, so it's not efficient for LCR and it's not efficient for NSFR. That's the argumentation. So banks were very prudent and stopped to make loan to each other or to make movement between each other. Okay, 19 will stop here. 20. Okay, so then it's wrong. It's not the case. The banks stopped to make loan to each other because during the crisis, during the great financial crisis, 2007, 2009, they had no clue on what could be the future, what could be the needs for liquidity. So they prefer to serve their own treasury and not to make, even if they have exceptional high level of cash, they prefer to keep the cash for themselves. So it's not the LCR per se. It could have a small impact, but it's not the main driver. Then question 7, if the LCR done or introduced because regulators were not looking properly at liquidity before the financial crisis. Okay. I will stop here. Okay, thanks for your answer. Yeah, it's true. Couple of countries were looking at short-term liquidity, like in France, not at all like in Belgium, not at all like in UK, to some extent like in the US. So the country by country, Germany was looking a lot on that. But so it means that country by country, a lot of regulators were not really looking at. And even when they were looking at, like in France, they were putting less weight on this liquidity ratio management. So French regulators stopped to ask for something close to an NSFR in 2005 or 2006, but still they maintain something close to the LCR with different definition just before the crisis. But in Belgium and UK, it was not a part of the toolbox. And last question for tonight, is the implementation of LCR creating the development of 32 days term deposits? Okay, they're very split on yes and no. Just think about the LCR characteristics. So I will most probably stop here. Okay. So then the answer is yes. It looks stupid. It looks weird. But in fact, if you have a deposit, a term deposit of 32 days, remember how LCR is built. If it's 32 days, there is zero outflow in the next 30 days. So due to that, it's a full, it's a resource which is very interesting because you don't have to build HQLA in front of that. It's a way to play a little bit with the regulation and the border. And it's a big lesson because each time you do a regulation, there is a border of the regulation and you create border effect. So regulator was not amazed by the fact that in certain countries, a lot of the term deposits were 32 days. But what you can say, the regulator asked for 30 days outflow, 32, there is no outflow. So then you need to be at the right time because after 15 days, a 32 will have an outflow in the next 30 days. So it's only playing a marginal role, but it's really interesting to show the border. Each time you make a regulation, each time there is something close to the border, which is a funny or smart thing, but not really in the spirit of regulation. So we finish the first session, and we finish more or less our time. So hopefully we will meet tomorrow same time. I will try to improve the efficiency of the class lecture, and I thank you for your attention and participation to the pools. And we'll try to make one or two exercise a little bit more developed tomorrow. So all the best. Good evening, and see you tomorrow. Cheers.